First, when there's a lot of borrowing to service debt, there's what's called, the death spiral is what we typically refer to that when a company has it, the government can have it too. And that is that dynamic where there's too much debt and you have to borrow to service the debt. And then investors know that that's a problem to service the debt. So the credit is worse. And that means that interest rates go up, which is the worst thing that can happen to a heavily indebted entity. And then as they rise, you get that spiral. You need to borrow more. When the currency depreciates, particularly relative to gold, Bitcoin, or other assets.
In the past few years, particularly since the Great Financial Crisis in 2008 and the more recent COVID-19 pandemic and its aftermath, there have been a lot of discussions about an approaching debt spiral or a looming credit event for the world's developed economy. Most of these discussions have centered around the U.S. economy as the world's largest economy, with a constantly ballooning debt pile, a huge debt-to-GDP ratio, and politicians who consistently refuse to address the situation. In his 2021 book, The Changing World Order, Ray Dalio, a renowned American investor, hedge fund manager, and author, analyzes the historical rise and fall of major empires and applies these lessons to the United States. He argues that the U.S. is in the late stages of its economic and geopolitical cycle, facing significant risks that could lead to decline if not managed properly. In a recent interview featured on the All In Podcast YouTube channel, Ray Dalio talks about the signs of this looming crisis and measures that could be taken to avoid economic and social instability, the two greatest markers of a declining nation. Before we delve into Ray Dalio's insightful analysis, it's important to point out a few concerning facts about the U.S. economy. Today, the U.S. has $36.4 trillion in federal government debt and a GDP of $29.1 trillion, giving a debt-to-GDP ratio of 125%. This ratio has climbed steadily since the pandemic began in 2020, when federal government debt was $20 trillion and GDP was just $21 trillion. Since then, federal government debt has risen by 80%, while GDP has climbed by 38%. To keep the economy growing, the U.S. government is running a nearly $2 trillion annual deficit, which is almost 7% of GDP, while paying over $1 trillion annually in interest alone on existing outstanding debt. The Congressional Budget Office, CBO, projected last week that annual budget deficits are expected to remain at 6.1% of GDP through 2035, significantly higher than the 3.8% average of the past 50 years. The national debt is projected to rise by nearly $24 trillion over the next decade. With these facts in mind, we have to ask, is the U.S. headed for bankruptcy? Stay tuned as we present key clips from Ray Dalio's interview, where he breaks down these critical facts and their potential impact on the U.S. economy in the coming years. If you find this video insightful, don't forget to like, share, and subscribe to our channel. Turn on the notification bell so you never miss an update on economic trends, market insights, and expert interviews. Thanks for watching, and we hope you enjoy the video.
To me, it's almost like the circulatory system. I think that credit is like blood that brings nutrients to all of the parts of the body, and it passes through a system that is like arteries, and then credit creates debt. And the key question, if it's healthy, is does the debt create an income that is more than enough to service the debt? And that's like, I don't know, eating vegetables or something. It's a healthy process. And if not, credit begins to build up this debt. It begins to become like plaque in the arteries. And you can measure it, just like you could measure it in the arteries. And you can see how it constricts that circulatory system, because as credit and debt service rise, you see that it eats up more and more consumption because you have to spend that. So you could watch the government do that. You can see that how interest is eating up and debt service is eating up, and that means there's less money. And then you also can see how heart attacks take place. And they're very, economic debt heart attacks. And the way they take place is by looking at the supply and the demand. If you have a lot of debt, and then you have a large supply of debt, that has to be bought. Somebody's got to buy it. And so that when you get to the point where there's debt risks, there's not only the new supply that has to be offered, but there is the possibility of holders of those debt assets selling those debt assets. And so the supply becomes overwhelming relative to the demand. And then what that means is it's the same dynamic as it for the government as it is for an individual or a company, except the government can print money. So when that debt service burden rise or there's a big supply-demand imbalance, if the government, most importantly the central bank, doesn't print money and buy it, then there has to be a rise in the price of the debt to constrict borrowing. And that borrowing constricted, that credit that is not going to come, will weaken the economy and cause bad economic conditions. And so they can let that happen, or they can print money and buy the debt and monetize it. When they do that, that's inflationary, and it lowers the value of the debt. In either case, you don't want to hold that debt because either there's a debt service problem or there's a depreciation. You get paid back with a greater supply and cheaper money. And that is the dynamics, and that's the mechanism. And because it can be measured, it can be seen in all countries, you can watch it happen. And so like you're going to your doctor, you can measure these things, you can see them, and you can know what needs to be done. And, a good example was in COVID. There were two waves. The first wave was the COVID wave, in which they put out, the government wanted to, and actually did, deliver a lot more money to people, companies, than there was a loss of income. So first wave, a lot of that money. Where did they get the money from? They had to borrow it. The central bank then came in and lent them. That was the primary. Then the second, when President Biden was elected, there was a second wave of that after COVID. It was mostly like a universal basic income thing. In other words, hand people money and we're going to be better off. And so they handed people money, doing that same exercise again. And so naturally, all these people got a lot of money. And so they deposited them in banks, they went out and spent, and so on. And it therefore shouldn't be surprising that we had a big wave of inflation. And we also had a lot of banks buy government bonds, which they lost a lot of money on. And that was that crisis. So that's how the mechanics work. You can't get richer by making money. And the purpose of money.
Because purchasing power is what matters at the end of the day. What your money's worth, what you can actually buy with it.
That's right. And there are two purposes of money, which is as a medium of exchange and a storehold of wealth. Saving is very important. And if you don't have savers who have it as an effective storehold of wealth, then you don't have a viable long-term credit market.
Yeah.
People don't understand that the bonds become a bad deal. You need that, like any marketplace, you need purchasers and sellers to be able to have an efficient negotiation to achieve a balance without the government coming in and printing a lot of money and messing up, make a big mess. It's like they made very severe negative real rates.
Right.
And we know what happened with the severe negative real rates. And the government, while they were making the significant real rates, it was the government that was the big buyer. Okay,
Yes.
so the government takes it on and they make negative rates. So what happens is then you get everybody leveraging up.
Yes.
Then you've got a problem. And so that's how it works. And it's a global issue.
According to Ray Dalio, the U.S. government's reliance on excessive borrowing and money printing is leading to a rapid erosion of the dollar's value. The Federal Reserve, in its attempt to manage economic downturns and government deficits, has engaged in large-scale monetary expansion, which has fueled inflation and reduced the real purchasing power of the dollar. This process weakens confidence in the currency, both domestically and internationally, as people and institutions begin to see their wealth devalue over time. A major concern for Ray Dalio is the potential loss of the US dollar's status as the world's reserve currency. Historically, dominant currencies maintain their global status as long as their issuing country remains economically strong, politically stable, and fiscally responsible. However, as US debt continues to rise to unprecedented levels and inflation erodes trust in the dollar, other nations, particularly economic rivals like China, are beginning to reduce their dependence on the dollar in international trade. Ray Dalio frames this issue within his broader theory of historical big cycles, where dominant empires and their financial systems follow a predictable pattern of rise, peak, and decline. The U.S., in his view, is currently in the late stages of its cycle, marked by high debt, increasing internal divisions, and declining economic competitiveness. He draws parallels to past empires, such as the Dutch and British, whose currencies and economic dominance eroded due to similar factors. Once trust in a currency diminishes, it becomes increasingly difficult to sustain global influence and economic stability. To navigate this period of decline, Ray Dalio advises investors to hedge against the weakening dollar by diversifying their assets. He suggests allocating wealth to assets that historically perform well during periods of currency devaluation, such as gold, real estate, and inflation-protected securities. Let's get back to the video.
First, when there's a lot of borrowing to service debt, there's what's called, the death spiral is what we typically refer to that when a company has it, the government can have it too. And that is that dynamic where there's too much debt and you have to borrow to service the debt. And then investors know that that's a problem to service the debt. So the credit is worse. And that means that interest rates go up, which is the worst thing that can happen to a heavily indebted entity. And then as they rise, you get that spiral, you need to borrow more, and so on. So that is also noticed when then there is the key spot is when the debt service becomes large. And then like the real red flag, the biggest red flag is when there's then the selling of the debt beyond the new supply, but the holders of it sell it. And then you can see it in the market action because you can see that long-term interest rates rise while short-term interest rates aren't rising or go down. So it's the free market losing its desire. You have a balance problem in the free market out there. And then you start to see that when the currency then depreciates, particularly relative to gold or Bitcoin or other assets, and sometimes other currencies. But typically, these things happen, broadly speaking, together, in which all currencies go down relative to other things like gold, Bitcoin, or tangible values. And so that's what it looks like. That's that edge. Then you start to see, the dynamic. So you either see the central bank comes in very quickly
I just want to highlight the CBO projection, right? So this is the U.S. government's debt as a percent of the U.S. government's revenue, which you indicate in your book is more important than debt to GDP. You've got to look at the actual revenue being generated by the government and how much debt they have. And the CBO highlights this expansion to 700%, meaning the government is going to have a debt level that's 7 times the income it's making every year over the next, I believe this is a 10-year chart. And you propose a bunch of actions that can keep it flat. And so I just wanted to kind of walk through that. And maybe you could frame this up for us a little bit.
Sure. Like that chart, if you go back to that chart, think about that chart as being, your plaque, so to speak, in the arteries and the debt service. So you could calculate all those numbers and you know what the picture looks like. And that is a stability. So number one is, I call it my 3% solution. Here, the solution is you must cut the deficit, which is the equivalent of bonds selling, down to 3% of GDP. And it's 7.5% expected. Now, different people have different views as to how to cut it. Forget it. I don't really care. Just you have to have a unified agreement. Everybody in Congress and the president and so on should pledge to do that. And then the question is how to do it. But they should know that number.
That's about $900 billion a year.
Yeah.
Roughly. And that means cutting it, as you point out, by cutting the deficit by more than half from where it sits.
Yeah, well, yes, because with the continuing the tax cuts, Trump's tax cuts, that'll be 7.5%, and you want to get it down to 3%. And it sounds draconian, but we did that kind of change from 1991 till 1997. And there are 3 keys to this. Do it soon, fast, when the time is good, when the economy's good. In other words, do it now.
Now.
Okay. The temptation is going to say, well, we're going to ease into this and we're going to be there and we're going to do it in 3 years from now. But if you have a bad economy, you cannot do it. Okay. And that's the worst. So we have the best economy, and the sooner you do it, the more you're going to do it. So 3% solution, do it now, and recognize that you have to deliver it. So if you're having, let's say, cost cuts in government, you have to own the number. So everybody's got to pledge 3%. Now, there'll be arguments as to how to get there, but you have to own the number. So much so that you'd say, if it's not 3%, throw me out of office because I've got to deliver that number. The other thing about it is to realize that if you make those moves, the bond market it will benefit. You see this, and so interest
rates will go down.
Right, and interest rates going down, interest rate expense is most important.
So when the president does an interview the other day, and he says, we need to get them to cut interest rates by 1%, and he's speaking about the central bank, he's effectively trying to force the central bank or coerce the central bank to take rate action when, if we were to cut spending, I think this is so important. If the federal government were to cut spending significantly and quickly, the market would naturally react to lower rates.
That's right. Okay.
I think that is so important for everyone to hear.
He's right. If you look at my calculations, you need 100 basis. If you get 100 basis points cut in rates, that's equivalent to significant cutting in spending. So he's right. But if you do that without the other parts, you're going to take money away. You're going to make it less desirable to own these things, these bonds.
Right.
And because that's going to be a problem. Where if you do these things together, they can support each other.
In the changing world order, Ray Dalio identifies 4 strategies the United States could use to stabilize its debt level and address long-term financial challenges. One of the most effective ways he suggests to manage debt is by increasing productivity growth. When an economy expands at a rate faster than debt accumulation, the debt-to-GDP ratio naturally stabilizes or declines over time. Achieving this requires significant investments in innovation, technology, and education. A more skilled workforce and advancements in automation and artificial intelligence can lead to greater efficiency and higher economic output, reducing the relative burden of debt. Another potential approach is austerity, which involves either cutting government spending or increasing taxes to reduce budget deficits. While this method can be effective in curbing debt growth, it comes with significant political and economic challenges. Cutting spending on essential programs such as Social Security, healthcare, or infrastructure can lead to public backlash and social unrest, while higher taxes may slow economic growth by reducing disposable income and business investments. Policymakers must strike a delicate balance to ensure that austerity measures do not cause more harm than good. In some cases, governments turn to debt monetization, where the central bank purchases government debt and effectively prints money to finance spending. This approach can provide short-term relief by keeping borrowing costs low and stimulating economic activity. However, excessive money printing carries significant risks, particularly inflation and a loss of confidence in the US dollar. If inflation rises too quickly, the Federal Reserve may be forced to raise interest rates, which can make debt even more expensive to service, creating a vicious cycle of economic instability. The challenge, therefore, lies in using this tool judiciously without undermining long-term financial stability. In extreme situations, countries may resort to debt restructuring or, in rare cases, outright default. Debt restructuring involves renegotiating the terms of existing debt, such as extending maturities or reducing interest rates, to make repayment more manageable. While the United States has not historically needed to take such measures, other highly indebted nations have done so to avoid financial crises. Default, though unlikely for a country with the world's reserve currency, would be a last resort and could severely damage global confidence in the U.S. financial system. Ray Dalio emphasizes that no single approach is sufficient on its own. A carefully managed combination of these strategies is necessary to ensure economic and social stability. If productivity growth remains sluggish, then some level of austerity or debt monetization may be required. But these policies must be balanced to avoid excessive hardship or inflation. Do you think the Donald Trump administration can effectively manage the situation and get us back on track? Please share your thoughts, comments, and observations in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on the notifications bell for more videos. Thanks for watching.